Many investors seek investments offering fixed income returns, but due to very low interest rates, options for investors can be limited. A reverse convertible is a type of structured investment often designed to provide investors with regular income and a return of capital at maturity. Some common features of a reverse convertible include a reference asset, typically a small basket of shares, coupons, fixed returns usually structured as regular income payments, for example 8% per annum paid quarterly, a fixed investment term, set at commencement usually 1 to 3 years, a barrier level. This is a predefined level and will determine if investors experience a loss. The barrier level is probably the most important feature for investors to consider. The barrier level is set at the start of the investment. It is expressed as a percentage of the starting prices of each of the shares comprising the reference asset. The barrier level is breached if on a certain date the price of any share has fallen below the barrier level. As an example, consider a 2-year reverse convertible linked to a basket of 2 shares. It will pay an 8% per annum quarterly coupon and has a barrier level set at 65% of the starting price of the shares in the basket. The barrier level is observed at maturity only. An investor decides to invest $10,000. During the investment term, the investor receives fixed quarterly coupons of 2% or $200 per quarter. At maturity, so long as the price of each share in the basket is not below the barrier level, for example, it has not fallen more than 35% from its start price, investors will receive all of their capital back. In this example, the investor would have received back $10,000 plus $1,600 in coupons along the way. However, if at maturity one or more of the shares has fallen more than 35%, then investors will only receive back capital based on the value of the fall of the worst performing share. So if the worst performing share had fallen 40%, then the investor will only receive back 60% of their capital at maturity. They would keep the fixed coupons paid during the term. In this scenario, that is $6,000 plus $1,600 in coupons, i.e. a net loss of $2,400. Investors should keep in mind that the returns are usually fixed, so if the shares increase in value above the starting price, they will not receive a greater return at maturity. Reverse convertibles generally suit investors that are mildly bullish, i.e. they think the shares may rise a bit, but not substantially. Neutral, i.e. think the shares will trade generally flat, or mildly bearish on the shares, i.e. they think they may fall a bit but not below the barrier level. A reverse convertible may not suit an investor that is very bearish, i.e. they think one or more of the shares may fall a lot during the investment term, or very bullish, i.e. think the shares may rise a lot. As with all investments, there are risks. The key risks associated with a reverse convertible include investors' capital is at risk if the performance of any share is below the barrier level on the relevant date. The investment is designed to be held to maturity. While liquidity is available, the value of the investment before maturity may be less than what investors paid initially, including if the investment terminates early for any reason. For a comprehensive overview of the risks, please refer to the relevant offer documents. Reverse convertibles offer investors an alternative investment structure that has the ability to generate positive income, even in periods where the performance of the shares is slightly to moderately negative, subject to the barrier level. To find out more about reverse convertibles and other current opportunities, please contact your financial advisor or C2 at info@c2fg.com.au.